Hi, I'm Jennifer Tescher, founder and CEO of the Financial Health Network. Great to see you back with us today. I'm joined this morning by Raul Vazquez, the Chief Executive Officer of Oportun. Welcome, Raul.
Thank you, Jennifer.
So I think you are in your offices in Silicon Valley, yes?
I am. It is I think, arguably one of the safest places in California because there are only 2 to 3 people here and the Wi-Fi is much more reliable than it is at my home with teenagers.
Excellent. I totally understand where you're coming from. So while I think that a lot of people know who you are, I don't want to take that for granted. We have a really broad audience today. So why don't we start by having you tell folks a little bit more about the company?
Sure. So we are a mission-driven community development financial institution that provides inclusive, affordable financial services. And the way that we do that is we are really focused on taking a deep data-driven understanding of our customer and applying advanced technology and data analytics to that. And what that's allowed us to do over the years is we have been able to provide installment loans. We've added auto loans recently, and we've added credit cards. We lend a range of $300 to $10,000. And in our 15 years of lending, we have now been able to lend almost $9 billion to 1.7 million customers. And we've helped 850,000 people with credit scores.
Wow. Talk a little bit more about that last part, helping to build credit scores. I know when the company was founded and through to today, the focus has really been on reaching underserved or harder to reach customers, particularly in the beginning, Latinx customers. Is that still true today? And of the folks who are coming to Oportun, generally speaking, what percentage of them would not be able to get a loan elsewhere because of not having a credit score or having a limited credit history?
So historically, what we've seen is about half of the customers when they first come to see us don't have a credit score. And as a consequence, they're not really able to go to a mainstream financial services provider. They're basically shut out of the mainstream financial system. So what we've really been able to do is amass a fantastic team of people that want to be of service to others. And that includes engineers, data scientists, marketers, everyone. And one of the things we've had to do, to your point, Jen, is we've had to figure out, how do you score the unscorable? How is it that you can collect enough information to make a responsible lending decision to individuals who others either don't want to lend to or can't lend to? We did focus primarily on the Latino community, and that was true when I joined the company 8 years ago. But kind of deep in the mission were the ideas of inclusion, belief, wanting to provide opportunity to others. And we really felt that the skills and capabilities that we had developed, that we were focused on providing to the Latino community, could really apply to anyone who had that need, right? Anyone who really needed an opportunity and a chance. And we've really been expanding the business over the years to help anyone, really.
Well, and that really is fitting point to talk about the racial inequities that we as a nation are grappling with again today. What kind of inequities have you seen and have been trying to fight against, essentially, in consumer lending? And is there anything new or different that this moment means for the company?
So I think I grew up in El Paso, Texas, which is not an affluent community. And part of the reason that I wanted to join the company was I really felt like the customers were my cousins, my friends. If things had gone a little differently, it'd be my parents and my siblings. And what I really felt I had seen and that we continue to see today are inequities in access to capital, in people's experience with mainstream financial products, in their exposure to financial concepts, because sometimes even if you have experience, you may not fully understand how all the concepts work. Access to responsible products and pricing. There are times when the need is so great that you'll take any product, and access itself can be helpful, but really What one wants to do is have access to things that are going to be helpful, to products that are responsibly structured and priced. And then finally, access to service support. So for example, we knew when our customers started to lose their jobs that one of the things that we're going to have to do was to figure out how are they going to make the math work, in their lives. And that part of that may be reaching out to lenders and asking for a bit more time. So we were very committed to picking up the phone within 10 seconds. And that's the kind of service and support that generally a prime or a super prime customer gets. And we wanted to bring it to low and moderate income consumers. So those are all the areas where I think there's been inequality in terms of a low to moderate income consumer in financial services. And right now, I think what we're really seeing is we're seeing a spotlight on virtually all elements of that. Because right now, our customers have lost their jobs. They may need capital, and they don't necessarily have access to those great products or access to that service and support.
Right. And as we know, but I think it's worth repeating, is that people of color are disproportionately more likely to lack a credit score or to be low and moderate income. So just by dint of your broader mission, you're more likely to be serving communities of color.
Yes, we are. And we have 342 locations right now in 9 states. And they are in those low and moderate income communities that generally don't get access to capital. I mentioned earlier that we are a community development financial institution. People in the audience may not be aware of that designation, but it's something that the Treasury Department provides to organizations that are fundamentally strengthening communities. And one of the ways that you can get this designation is to demonstrate that you are providing capital to those communities that don't necessarily or don't easily have access to it. And that you're doing it in a way that is going to strengthen that community. We've been a CDFI now for over 10 years, and part of it is that almost $9 billion that we've been able to provide to these communities that, to your point, Jen, tend to be low and moderate income and tend to be communities of color.
Yeah. So you started down the path of talking about how your customers are experiencing the results of COVID and the economic fallout. Why don't you tell us a little bit more about what you're seeing, what you're hearing from your customers?
So what we're seeing is our customers were among the first to lose their jobs. So in really the middle of March, as California, New York, as a lot of places started to put shelter in place provisions in the economy and in society, that was really when the layoffs started to take place. And we very quickly, within a few days, started to get a lot more inbound calls. And we started to reach out to a lot of customers to try to figure out if they need help. Our approach in terms of servicing and support has always been to get in contact with the customer, figure out if something happened that has led to a delinquency, and figure out how we can be helpful and give them enough time to get back on their feet and to be able to pay us back. So very, very quickly in mid-March, we did see that our customers were among the first to lose their jobs. The next thing that we saw was really an urgent need for support of people saying, I need 30 days to try to find another job. And after 30 days, in many cases, they've asked for yet another 30 days. And we've been there to try to help them with that. And then unfortunately, clearly, what we've also seen is that these communities of color and our customers are over-indexing in the likelihood to have to deal with COVID-19, to be hospitalized, and unfortunately, fatalities. So we're really focused on trying to make sure that we're doing everything we can to continue to strengthen communities and continue to be there for our customers, because we know our customers are resilient. We know they're the heroes that are at the front lines, keeping us fed, keeping us safe, keeping all of us well provisioned. So we want to make sure that we're there for them in this difficult time.
In a way, it feels like you have been on the leading edge or the bleeding edge of the pain that some communities are facing. There's been a lot of discussion now about how the additional unemployment stimulus is about to end, and increasingly a number of the programs that people have availed themselves of to defer loan payments, to take forbearance, may be coming to an end. How long do you think lenders should go in trying to provide people some relief in this moment. What do you think is realistic? You are a publicly traded company. There are rules about how long you can carry impaired debt. Talk to me a little bit about, not just for you, but sort of writ large, how you think the lending community needs to be approaching that.
Yeah, I think this is a time to try to think long term. This is a time, I think, in which these ideas of inclusive capitalism and not just being focused on shareholders, but being focused on stakeholders broadly, right, including customers and communities, that idea is going to be tested to try to figure out, are these just words, or is this something that, you know, the different leaders in different companies are committed to? One of our board members shared with me an expression that I keep thinking a lot about during these times, which is, don't let what you see cloud your vision. And what we're really focused on right now is seeing the heroism of our customers, seeing how resilient they are. And because when we lent in the last recession, knowing that they are trustworthy and they are reliable, but they may just be dealing with the effect right now of a horrific situation, right, across their jobs, across their health, and just giving them enough time. So I'll tell you what I hope the financial services industry does is that they think about long-term value, that they think about long-term relationships, and that they're not just solving for the P&L of this quarter or the next quarter, but that they're thinking that if they stand by that customer today, that customer is going to remember and that customer is going to reward them over the long term. That's how we're thinking about it. We've worked with the people that lend us capital and let them know that we're going to be there for our customers, and we're going to demonstrate care and compassion by believing in them. And if they tell us that they've lost their job, we don't ask them to prove it. We say, okay, why don't we go ahead and delay your payments? Or why don't we, if you can make a payment, let's figure out a way to restructure your loan so that way we don't make their life harder. We can provide them with a solution that gives them a bit more breathing room.
So let's talk a little bit about the effects of credit in terms of stabilizing a customer or a community. You've talked a lot about one of the hallmarks of what Oportun has always been about is creating that access. How is credit a stabilizer? And in what situations is it not a stabilizer anymore?
So credit is, it's so interesting because it's a thing that so many people and businesses take for granted. But the power of credit, I think, is that it allows you today to have access to a resource or to something you want that you could not afford if you had to pay for all of it today. So as a consequence, credit allows you to get that benefit while paying over time, right? So credit can be a stabilizer if you have an emergency that arises and you don't have enough savings to be able to pay for whatever that service is that you need. Think of a loved one being hospitalized, right? Which clearly is happening a lot right now. Think of a car that doesn't start in the morning, or one of the things we know is there are a lot of multi-generational families that we serve. And that can also be a contributor to the spread of the disease. So if someone wants to go ahead and say, you know what, why don't we get another apartment and maybe spread out a little bit? They may not have enough money for deposit, but a loan can help with that as well. So that is where credit can be a stabilizer, is it can help a family, it can help a community absorb shocks. And then the same is true on the business side in terms of allowing individuals to pursue an entrepreneurial dream. How is it that they can afford the tools or the equipment or the labor that they're going to need to go ahead and start their business? Today, we're focused on consumer lending, but from a mission perspective, we've talked for years about wanting to do small business lending. And this is a reminder of how powerful capital can be in those low and moderate income communities to also allow someone to start a business, help them create wealth, help them create employment opportunities in communities.
I'm gonna come back to you on the question of when is credit not a stabilizer. But before we go there, we've had a couple of questions from the audience. One person was asking, are you using a network of lenders or do you do the lending yourself? I believe the answer is the latter, but you might want to just describe a little bit about what the customer experience is like, both physically and virtually.
Sure. So let me talk a little bit about our customer. Our customer on average earns about $45,000. Half of them are supporting a family with that very meager income, very modest income. And we know that they may be working more than one job. So one of the things that we were always very focused on was trying to make our service as accessible and as convenient as possible, while also adding elements of financial education and helping a customer understand the structure of our product and the obligation that they were about to enter with us. So we basically serve a customer through online. If someone is going to their computer or their mobile phone and doing everything themselves, let's say because they have two jobs, they've got a family and they don't have a lot of time to come see us or to talk to someone, we're happy to serve them that way and they can do it end to end. As you can imagine, with shelter in place, we've got more and more people using that online channel that we provide to be able to get a loan from us. If a customer maybe has questions because they've never had a formal loan, they've only borrowed from friends, and they really want to understand how our product works, they can come to one of our 342 locations. Those locations are either in a place like the Mission District in San Francisco, where we'll have a standalone location that will be where our customer lives, where they work. Some of our locations are in grocery stores, a place where our customers are accustomed to coming frequently. And that really gives us an opportunity to explain our product and even to take payments in cash. Our customers have historically made about 40% of their payments in cash because they're comfortable in the cash economy, and we're happy to take their payment. And then if a customer, say, wants to call us over the phone, they don't have time to come in, but they do want to speak to someone and have their questions answered, we've got contact centers that are available 7 days a week. And customers can use the channels in any combination. So that's how we work with the customer. And it's really about how do you meet the customer where they are and do it in a way that is going to be understanding in terms of any doubts or concerns they may have or any handholding that they want to enable, right, or take advantage of in entering this formal financial contract with us. And it's all our lending, yes, not through other partners.
So when Oportun started, you were only physical, and it was quite some time ago. It was pre-iPhone when the company started, so right. That makes sense. And the notion of the interpersonal, I know, was a big part of the DNA. Obviously, times have changed, and you have now a mix of channels, both virtual and physical. I think there's always a lot of talk about high tech versus high touch in providing financial products and services, particularly to lower income customers, people who may not have had a lot of experience with the system before. And as you said, that's being tested right now with shelter in place. I wonder if you can describe whether you've seen any changes in your customer behavior. Like, for instance, you mentioned that in the past, you were seeing upwards of 40% of your customers pay in cash in person.
Right.
What is that looking like now? And do you think that this experience of COVID will change the mix, that maybe some of your customers aren't going to need the in-person as much anymore, or maybe you'll think differently about your mix of stores versus virtual?
Yeah, so I think I'd start by saying, we really try to think in terms of ands, not ors. So that this idea of high touch versus technology, we think is a false choice. I mentioned at the beginning, we're really powered by a deep understanding of our customer, and then we add a lot of technology to that. We believe that being in the communities that our customers live in give us a lot of insight into the customer and help us serve them better. And we believe, to your point, that even during this difficult time, that there continues to be a role for a physical place where you meet someone. So historically, about 40% of our payments have come in cash. We have seen traffic decrease because of shelter in place, but we've still had over 30% of our payments come in cash. Even in these times, customers prefer to come see us and pay us in cash and talk to someone in person, either for an application or a payment. So we have kept our locations open. We've been part of the critical services infrastructure. And the insight that we're gaining as we talk to customers and as we talk to our employees who are members of the same community helps us serve our customer better. And it helps us develop the technology in a way that is going to be more useful to our customer.
I'm looking at some audience questions here. There's a question about what's your underwriting process? So in other words, how are you creatively assessing a customer's ability to repay, especially given that half your customers don't have a credit score or other traditional kinds of assets or collateral?
Right. So I'll start by saying we didn't touch on this earlier, but some work we did with the Financial Health Network was very helpful in helping us understand how our rates and costs compare to others. And the work that we've done has helped us understand that we charge on average 1/4 of what others charge our customers for credit, and compared to payday, it is 1/7. On a dollar basis, that's about $1,000 in savings on just the first loan. And as a consequence, we try to be very focused in terms of having a good understanding of who are we best serve, who are we best suited to serve, and trying to be as efficient as possible. And I bring that up because it'll help explain the process that we go through. So the very beginning of the process is asking for a little bit of information so that we can try to query the bureaus and understand, are you in the bureaus already? I mentioned that half of the customers when they first come to us are not, the other half are. So the very first thing we try to understand is, what is your experience with credit? If you've had a lot of experience with credit and for a variety of reasons it hasn't worked out, we are going to tell you that we're sorry, but we're not the best person to lend to you. And that's because our models are not tuned to that person that's had a lot of experience with credit. Our models are really tuned for people that have had little experience or no experience with credit. And as a consequence, right away, out of respect for the customer's time, and so we can be efficient, if you have had that experience, we'll turn you away and let you know that there are other people that are more likely to be able to help you. That focus then allows us to continue the process and ask a customer, where do you work? Where do you live? How long have you worked there? How long have you lived there? And other information about their income and expenses, so we can start to get a sense of a person's cash flow. Once we collect that information, we enter then the next step of the process. And at that point, that all that technology I mentioned earlier, we've got data scientists, we've got engineers, risk analysts, a lot of really talented people. And what they do is they've created an engine that at that point in the process goes out and looks for a tremendous amount of alternative data, brings that all back. And with that, we've created a risk tree that ultimately lets us know, are we going to lend to you, yes or no? And if so, how much?
Give some examples of what that alternative credit data looks like.
I'll give two that we share publicly. One is, if you're a prime or a super prime customer, chances are that you've had your cell phone for a long period of time. You haven't changed your number. You've never been in a situation where financially things have gotten so tough that maybe you had to walk away from your cell phone bill. So one of the things that we try to understand is, how long have you had your cell phone? Because it can be a signal of your willingness and ability to pay over time. A second one is when you have a mortgage, your mortgage provider reports to the credit bureaus. And that can give us a sense of how long have you made timely payments on your mortgage. But the overwhelming majority of our customers do not own a home, they rent. And renters generally don't have their performance reported to the credit bureaus. And this is where you have a chicken and the egg problem. You can't really have access to responsible credit, right, until someone has reported that you're a responsible borrower, and no one's going to report that you're a responsible borrower generally until you've had access to a mainstream financial services product. But now there are more and more data sources where you can go out and you can figure out, oh, Jennifer has been renting. She's been renting at this place for 6 years, and she's a phenomenal payer of her rent. She is very, very timely. And that can be another signal for us, for example, right, of your ability and willingness to pay. But we look for a lot of signals like those. We bring that back and we create our own proprietary scores. And if it's available, we'll combine it with information from the credit bureaus to make a lending decision.
So you mentioned that your underwriting process is tuned to people who haven't really had a lot of experience. But I know that you are keen to keep lending to those people over time, particularly as they build experience. So how do you sort of manage that, given that on the front end for a first-time customer, you're not looking for folks who've had a lot of experience?
So that we seek to serve 100 million in the US, 100 million individuals in the United States who either don't have a credit score, or we think the bureaus are fundamentally misscoring them. And the 15 plus years of experience has given us a chance to differentiate between those 45 million people who don't have the score and then the 55 million people who just aren't being served well by mainstream institutions because the bureau doesn't accurately portray who they are. So to your point, that first loan may be to someone who doesn't have a credit score. And after 6 or 7 months of working with us and having us report to the bureau, they'll get a score. At that point, they go from being invisible to every large institution who knows how to mine the bureau starts marketing to them. If that customer decides at that point to work with someone else, we think we've done a wonderful thing from a mission perspective, because that customer now has choice and they have experience with a product, with a financial services product. We think that experience is really critical. I know a lot of people talk about financial literacy. And the thing I think about is there's only so much I can read about driving a car. At some point, I've got to get behind the wheel to really understand how it works. And we think that experience is really either if they choose to stay with us, which was your question, and I'll get to that in a second, or if they choose to go and work with someone else. And from a mission perspective, then we think we've done a great thing because we've provided that expanded choice set and expanded access. If a customer is so happy with our service, and by the way, our net promoter scores are on par with the Ritz-Carlton, with Nordstrom, with Netflix, with Apple, with Amazon, with companies that we generally hold in high regard as consumers. If a customer chooses to stay with us, what we do is we give them access to more capital, if that makes sense, by extending the term, and we drop their rate. One of the principles that you and other organizations have articulated of responsible lending is a customer should see a benefit from performing well on their loan, and we absolutely agree with you. And that's part of the way that we earn the right to keep serving our customers. And that's how we think about it. Once they've got a credit score, then we've got to really compete with the Wells Fargos, with credit unions and others, and we have to earn the right to be able to hold on to that customer and have them choose to stay with us.
Thanks. Let's go back now to the question I posed earlier about when is credit a stabilizer and when it is not. That's a tricky question. And I know your borrowers, you ask for a reason that they're borrowing, but at the end of the day, right, honor system, people might be using the money for whatever they want. And also, you know, we're at a moment in the cycle where even though people deleveraged significantly post 2008, most of that deleveraging was on the mortgage side of the house. And credit card and auto loan and student loans are, you know, back at levels that we haven't seen since that last crisis. But at the same time, also, we're seeing lenders understandably pull back in this time when people have less income coming in. In fact, someone specifically asked from the audience, have you pulled back on deploying credit right now in this moment? So how do you think about all of that, right? You've got conflicting messages coming at you. How do you make sense of all of that?
Sure. So we've created a business where we have sought to align very closely with the customer. And what I mean by that is if a customer is successful, then we're successful. And our best and most profitable loan is a loan that is never delinquent and that is either paid on time or even paid early, right? Delinquency for us is not a profit center. And that's very different than the way that some other businesses are structured and some other products are structured. So for example, one of the criticisms of payday is that a lot of the revenue is generated by the product actually not getting paid back, but instead being extended over and over and over again. And I am a believer that design is a reflection of intent. So we have designed a product so that a customer can feel that it is affordable and that they will be able to pay us back without being delinquent. So what that means is going back to when is a loan not a stabilizer? We mentioned that the power of capital is allowing you to buy something today or to take care of a problem today that you would not otherwise be able to do, and being able to make that payment over time, right? In that case, it is a responsible product. If you're able to pay it over time without creating hardship in other parts of your life, then it is that stabilizer. If it is a product that is not structured to allow you to do that, either because it's got prepayment penalties, or the payments are so high that you're not going to be able to afford them without creating hardship, or there's a big balloon payment at the end that means you're going to have a hard time, then it is not a stabilizing force, and it is going to create anxiety and stress and hardship in other parts of your life. In addition to that, if the lender is reporting to the bureaus on a product that was not structured for success, it is not only going to hurt your ability to get access to financial products in the future, but some states pull credit scores as part of making an employment offer, right? A lot of renters, or people that are providing rental properties, also pull credit to decide if they're going to rent a place to you. So entering into a poorly structured product can destabilize not just your access to other products, but your access to employment, your access to residences. So that's where we really think that design, right? The design of a product to ensure that it is responsible and affordable is critical to ensure that it is a stabilizing and positive force.
I'm going to try to get an accord done of my own now.
Okay.
So it's really interesting to think about Oportun in this moment where we're not just talking about stabilizing people, but we're also talking about stabilizing places, stabilizing neighborhoods, stabilizing communities. I, many years ago, worked at Shore Bank, very place-based institutions. And the idea was that Shore Bank was an institution that believed in the community, and by being there was sending positive signals to others that it was safe to invest, safe to engage, safe to locate there. And I'd never really thought about that as it related to Oportun until now. I had really thought more about your locations as being really customer centric, like being where the customer is. I'm curious, in this time of COVID and also, civil and social unrest in community, are you thinking differently now about the role that your physical locations play and that Oportun plays as it relates to stabilizing not just your customers, but the communities they live in?
Absolutely. Yeah, we spent a lot of time thinking about this. Four things come to mind. Number one, just the ability to capital, right? Going back to everything we've talked about. And I'll be brief because I know you've got other questions you want to get to, but we think that being in that place gives us an opportunity to provide more capital than if we were just online only. The second is jobs, right? There is something just very empowering, and there is a dignity to having work. So having those 342 locations means that we're able to employ over 1,000 people in low and moderate income communities, and not just give them jobs, but give them careers. And that's also been something that we've been very focused on at this time. And this goes back to short-term versus long-term and stakeholder capitalism as opposed to just your shareholders. We have not laid off a person, nor have we furloughed anyone, because we think in this difficult time, right, to cut back people's income would weaken the community as opposed to allowing them to be at a good place mentally and provide for their families by having their jobs. So we think that providing jobs is a key part of being in that place, to your point, Jen. The third is we're really we've been talking about this for some time, but we've got a lot more clarity now. We're going to try to turn our locations into community centers. We have always sought to strengthen the ecosystem in the communities that we serve, because nonprofits, for example, do phenomenal work, and they do so many things better than we do. And we've always sought to partner with them. But what's become really clear is because we were able to keep our locations open, we can become a platform for being able to identify and serve a lot of individuals that need more help than what we can provide. But a lot of nonprofits weren't able to keep their locations open. So they've had to try to figure out virtually how to help people. And that's created some challenges. So we think we can help that way. And then finally, I think because we talked about this years ago, we think that our mission-driven for-profit model that in many ways, I think, combines the heart of a nonprofit with the sensibility that a lot of us have learned in our careers, can serve as a model potentially for how to really tackle difficult social issues. For us, it's access to capital. What we're seeing right now is we're seeing a lot of the other challenges that we have as a society are really being laid bare, and we can all see them. And we hope that we can demonstrate a different and more scalable approach to dealing with some of those issues.
I can't think of a better place to end the conversation. Raul Vazquez, thank you so much for joining us today.
Thank you so much for the opportunity. Nice talking to you, Jennifer.
Same.